2023, a year starting off with record uncertainty, record fear, and record doubt. How could a retail investor possibly navigate a year after the destruction we've seen in 2022? Well, there is some light at the end of the tunnel, and in this video I want to share what my investing strategy will look like in 2023, how I'm adjusting it from 2022, and historically, how have stocks performed realistically in a time of recession and high inflation. There's a lot of data we need to look into, and chances are you're probably not going to agree with a lot of the information I share, but at the end of the day, that's what this channel is all about. It's about sharing different opinions so that people can reach the best conclusion possible. And obviously, I've personally made some mistakes in 2022 that I would definitely like to avoid to reduce my unrealized losses in 23. And that is exactly what I want to share in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's understand the fact that 2023 is going to be a recessionary year. No matter what happens to inflation, interest rates, the damage has already been done by the Fed. The 2022 interest rate hike was one of the most aggressive cycles we have ever seen in the history of the United States. And with the US being the biggest country in the form of GDP globally, it's going to have rippling effects across the entire world. And most consumers with the crash of real estate and used car prices are also expecting a recession. The personal savings rate is at all-time lows, stimulus checks have worn away, credit card debt is at all-time high, and people simply can't catch a break in the stock market, resulting in people feeling a lot less wealthier than they actually are. And it's true, we have seen a lot of wealth completely disappear out of most retail investors' hands. We saw the SPAC crash of 2022, where all the companies that went IPO that were unprofitable and small cap growth companies have declined 70 to 90% in 2022. I also fell victim for a few companies of those, and I'm still struggling to understand how my conviction can develop after such a massive bubble, and how you can really develop trust from so many investors that were pitching these companies over the past 2 years. But in the midst of these massive destructions that we've seen across basically every single asset class in 2022, whether that be crypto, stocks, or bonds, I think there is light at the end of the tunnel. We have seen a massive amount of destruction in mega cap stocks. This means that people are likely sitting with a record amount of cash on the sidelines going into 2023. And the reality is that 2022 has not even been a recessionary year. We saw only 2 quarters of GDP decline that ended up bouncing in the third and the fourth quarter of 2022. So how could 2023 possibly be a severe recession, which is what many retail investors expect, if 2022 so far has already seen so much market cap get completely erased? Well, that, my friends, is what we call the market's forward-looking mechanism. The market is always running 6 months ahead of what's actually going on in the underlying economy. And even though 2023 is a recessionary year, and you want to be careful about the kind of companies you're investing in and how much cash you're saving on the sidelines, because obviously real estate lags the stock market significantly, is likely going to continue to go down in 2023. Stocks do tend to perform well in most recessions. Now, obviously, 2008 was a massive anomaly because in 2008, we had an actual financial crisis that came out of nowhere with the bankruptcies of some of the biggest banks in America. But as you can see, during high inflation recessions like we saw in the 80s, the market doesn't actually perform that poor. In the very first inflationary year with the Fed raising interest rates in 1975, the market went down around 18%. That's very similar to what the market's down right now in 2022, around 21% for the S&P 500. But the years following that, even though inflation was still high and interest rates were still going up, as you can see, the S&P 500 actually went up 16%, 14%, and then 7.6%. And after that, the market did not decline until the dot-com bubble of 2001, which obviously was more than 10 years after the bull run started. So unlike what many people are thinking about this recession in 2023, it does not necessarily mean that stocks will underperform. Yes, some stocks will, and chances are fear, uncertainty, and doubt is going to continue to drive the market. But as an investor, you want to use this as an opportunity, which is exactly what I'm going to be doing next year. My thesis that growth stocks are extremely undervalued will not change. As you can see, year-over-year returns of the MSCI USA Growth Stock Index is at record lows comparing to the 2001 dot-com bubble. even in 2008, growth stocks did not get hammered as much. And that is obviously because of the fact that we actually saw a bubble in growth stock valuations in 2020 and 2021, similar to what happened in the dot-com bubble of 1998 and 1999. And so as a result, valuations have a very big opportunity to actually rebound to the mean right around here. We saw that happen in 2002 after the market bottomed, and chances are we're going to see a similar opportunity here in 2023, where if the interest rate and inflation story remains constant like it is right now, then chances are the market could rebound significantly in the form of valuations. Now, this does not mean that every single growth stock that you own, that I own in my portfolio is going to go up, because every company is built different. You have to make sure that the cash position of the company is significant, the company is not at risk of bankruptcy, or the company is actually growing revenues in this environment, not declining revenues. But nevertheless, as somebody who's investing in small cap stocks, this is something that I'm definitely watching. And guess what? The reality is, as of right now, inflation has officially peaked. The supply chain situation has improved a lot, shipping costs have come down to record lows, and when you have so much talk of a recession, inflation is naturally going to come down. I feel like people forget to understand the fact that an inflationary period and a recessionary period are the exact opposite of each other. They cancel each other out. They're not going to overlap at the same time, obviously, and that's what's going to create these imbalances, but a recession is inherently deflationary. Meaning if we expect one next year, then we should see inflation come down. And as we all know, inflation is what's been driving the Fed. And if the Fed's going to lower rates or keep rates positive, then the market is going to see some massive relaxation, because that's going to help us keep the 10-year treasury down. So for me, given the current data, I'm going to continue to dollar cost average in my growth companies. I am going to make sure that the companies I'm buying are executing based on their plan. They're not burning an excessive amount of cash, and then they have a roadmap to raise money in the next few years, or they have some massive tailwinds from macroeconomics or policies that could help their business. And that's obviously because as a growth stock investor, I don't have the luxury of looking at a profitable income statement. There's no profits, there's no EPS, there's no PE ratio when it comes to investing in growth stocks. It's more about focusing on the business, their growth story, their fundamentals from a balance sheet and revenue perspective, and how that's going to evolve over the next few years. And the reality is that when the 10-year yield is going up, when interest rates are going up, these companies get destroyed the most. It's the simple reality. Growth stocks will always get destroyed first and the heaviest when interest rates are going up. So if you are one investor in the growth stock space, then you kind of want to pat yourself on the back if you've survived 2022, because this is on track to be one of the worst years for growth stocks in history. This has been the most aggressive interest rate cycle, and every single time we see the 10-year yield spike like it has right now, there's always a massive economic event that has occurred because of it, and most investors do tend to regret not buying during those massive economic events. And so as a result, 2023 could be a similar story to 2022, but the situation has changed a lot because of inflation. So chances are there is a high probability the market does somewhat start bottoming next year. Now, obviously, because investing in growth stocks itself, even if you're diversifying, is still extremely risky, I do have a separate portfolio in my Roth IRA that is focused mostly on investing in ETFs. I try to focus on ETFs that track index funds because obviously that's where you de-risk your investment the most. One of the main indices that I'm buying is the IWM, which tracks the Russell 2000 index, which is mostly around small cap companies, which, as we know right now, are trading at extremely big discounts. The other ETF that I'm going to be buying more in 2023 is going to be the Crane Shares China Internet ETF. China is one of the sectors that I'm quite bullish on because it tends to be lagging what the US economy is doing. And right now they're expected to go in an interest rate cutting environment next year. And overall, the economy is just way too important for the global economy to be thrown out the window. And it looks like this index is near bottoming. So I'm going to be continuing to invest in this one next year. Following that, I'm going to also be investing in the XLV Healthcare ETF, which is the sector of the S&P 500 that tracks healthcare businesses, which obviously tend to stay very resilient during times of recession. And as you can see already in 2022, it has far outperformed most of the tech companies. And then finally, because technology is still growing at a rapid pace and innovation is at an all-time high in the United States, I'm going to be dollar cost averaging into the XLK S&P 500 ETF. This tends to track the technology side of the index, which obviously has been gotten hammered in 2022. But because some of the biggest companies like Amazon, Google, Facebook, Microsoft are all tracked under this index, I feel very comfortable dollar cost averaging into this one, given the fact that this has always outperformed during bull markets. And obviously, as many of you know, I am very much of a contrarian investor. Like one of my favorite investors, Adam Koo, laid out in this post, typically markets always bottom when there is peak pessimism. Even after the market bottoms and the news turns out to be good, inflation's down, the Fed is cutting rates, there is no recession anymore, the market is always going to be way too high. Chances are the market's going to be at all-time highs by the time you see all that good news. So waiting to buy stocks or any asset after all the bad news is over is a really poor investment strategy. The money is always made during times when people are panicking out. And right now, given the insane destruction we've seen in valuations, I'm seeing a lot of pessimism out there on Twitter from most retail investors. Yes, even myself, I've lost some faith in some of my companies, and it is definitely very depressing to see the market go down. But as this chart clearly shows, it is always a good time to be an investor when people are rushing out. Granted, you're buying the right companies at the right times. Even after the market bottomed in March of 2020, people were calling this a fake rally. And chances are, any rally we see in 2023 is going to be exactly that. It's going to be a bear market rally, and people are going to say you want to sell in the strength, not buy. But that is exactly what has led some of the biggest investors in the world to lose money during recessions. They always sell out at the bottom and miss out on the run and the bull market that follows. And that is exactly the mistake that I personally don't want to make, regardless of how wrong I look in the short term. Things could be completely different this time, and I could be 100% wrong, so definitely don't take my word for it. Make sure to do your own research, your own due diligence, and your own companies. But obviously, that is my take on the situation, so let me know your thoughts down on the comment section below.